Yes, guys and girls, welcome back to another BMO video. It is Tuesday, the 29th of July. Obviously, as you can see, Drew's not here. He's unwell at the moment. Hopefully, he'll be here for Friday's breakdown. But for now, you have got me. Now, let's quickly run straight through into the news and see what we have going on. So, let me just move this over here. And there we go. Now, if we start from Monday, you can see yesterday was pretty dead. Literally nothing happened. Yeah, I've got everything turned on. Yeah, nothing happened yesterday in terms of news. You may have seen some news about the tariff scenario where there's been some sort of deal being struck between Europe and the US. And in that scenario, the dollar did do pretty well, largely on the basis that it seems as if deals are now starting to be made because, as you know, if deals weren't being made, it would allow the dollar to sort of stay weak because it just creates more stress for them. I believe we spoke about that last week. As a result, euro dollar has been falling. It seems as if we've now broken through this 116 handle that is quite strong, and 115 would be the next level for us to watch. And we will just repeat the same process where we just look at, we look at the news, the fundamentals. Does it still make sense now for us to get back into another long? Yes. Okay, cool. Let's do it. And then we'll move on from that. But yeah, today you can see that there's not much. Spanish GDP wasn't really a market mover. Jolt's job openings is at 3 o'clock, 3 p.m. UK time. And as you know, Jolt's job openings is generally the first set of data before we have NFP on Friday. But yeah, as I was saying, Jolt's is more like Indeed for the UK, but that can be quite skewed in terms of data. It's not the most accurate, but it does give us a little bit of a guidance as to whether or not, NFP is going to be relatively good or not. Then conference board consumer confidence, you can look at that, but that's expected to stay a little bit stronger. Wednesday, we have CPI from Australia. So that's going to be interesting to see. We'll just have to see how the AUD reacts to that, because what we know is the RBA, as you may have saw last week or the week before when the last meeting was, they suggest, or they held rates when markets are expecting to cut. And the reason they said that is because they're thinking about inflation. So if inflation tomorrow morning stays strong or sticky, then that gives the market an idea that maybe the RBA will be a little bit more hawkish at the next meeting. They may cut, but it would just, the language would be pretty hawkish, and that should support the AUD. ADP as well, that gives us a little bit of a guidance on NFP. GDP, going to be pretty big. Bank of Canada, going to be pretty big. You can see markets expect them to hold, so it will obviously be about what the conference is going to be. And then the Fed funds rate, the FMC as well, on Wednesday, so tomorrow is going to be pretty volatile. Then Thursday, we have not much. China manufacturer PMI probably won't do too much. BOJ meeting, you can see markets expect them to hold. That's fine. Nobody's really expecting to hike rates. So let's see what they say in the statement and the press conference. CPI preliminary from Germany is also going to be pretty important. Then GDP from Canada, PCE, employment cost index, and the unemployment claims on Thursday from the US. Then Friday, average hourly earnings, non-farm payrolls, NFP, unemployment rate, euro inflation. So tomorrow, Thursday and Friday is going to be pretty volatile. So be a little bit careful. And then lastly, we have ISM manufacturing PMI expected to stay roughly the same. So apart from that, again, dollar has been strong. We were speaking about the dollar could remain a little bit on the stronger side in the near term, because again, there's not that much negative news for them at the moment. But let's see how this week develops from a news perspective. And as we spoke about last week, it's about now what the Fed is going to say, because it seems as if there's deals being made between Europe and the US, which does benefit, to be fair, both economies, but markets are driving with it more for the dollar, because it just means that potentially other deals can be made with other people, because Europe is quite stubborn. So if that suggests to markets that, Trump is open to accepting deals, that should allow the dollar still to remain a bit on the stronger side, at least over the near term, at least until we have a good guidance. I'm not sure off the top of my head what seasonality is I can never remember, for August for the US, but you can also consider that. But yeah, apart from that, technicals, not too much. Obviously, a bit more dollar strength, so that's fine. But yeah, apart from that, We may do a little bit similar to how we done last week's breakdown, where we just go through certain economies rather than stop, start, stop, start. I will stop and start at certain points because I do need to eat lunch. But apart from that, let's move straight through onto the US dollar. So the USD. In regards to the dollar, let's quickly have a little look. Obviously, as we spoke about at the start, it is a little bit stronger, and that's largely because of deals being made. It just means there's less stress from a tariff perspective now. That's good news for the US. Also good news for Europe as well. Don't forget, even though you have seen Euro weaker, it is still relatively good news for them that there's some sort of deals being made. It seems as if, though, markets are starting to just take profit on a lot of that extended longs on the euro across the board, especially against the pound. But we'll get onto that a bit later on. So firstly, let's start off with this one, which is, where am I? This one over here from Bloomberg. And what they say is the dollar hits strongest level in 5 years before key US data. Now, a gauge of the dollar rose to its strongest levels in more than 5 weeks on speculation of slew of US data releases will offer further signs of economic resilience. The euro extended its slide to the weakest level in more than a month amid concern over economic impact of the euro's recent trade deal with the US. We'll, of course, read through that over in just a moment, which is this one. And they just talk about a bit more on the tariff perspective. Faces 15% tariffs on most of its exports to the US. And that could also be a contributing factor as to why the euro is a little bit weaker, just given how it could impact the economy. It's good in two avenues, that it's, not as stressed for the euro anymore at that point, but the reaction function tells us otherwise, that it seems as if it's a little bit more worse for the euro, at least over the near term, until markets have a bit of a better gauge on that perspective. Now, the consumer confidence data is expected to have improved in July, and JOLTS opening statistics are due on Tuesday. On Wednesday, Fed is forecasted to keep rates unchanged, while growth and inflation numbers are seen reinforcing the picture of a buoyant economy. For now, at least, the focus for FX markets participants have shifted away from the trade uncertainty and onto the resilience of the US economy. This is clearly helping prompt some short dollar position liquidation built up through the first half of the year, which is true. You may have seen that there was a bunch of shorts on the dollar. Now, the narrative over the coming weeks will turn to focus on Europe's sluggish economy, constrained fiscal room, is certain key countries disappointing real yields, and now a trade loss to boot. Expect a lot of chatter about the US exceptionalism making a comeback, and if that is true, and we start to see more and more people talk about that, that could allow the dollar to remain a bit on the stronger side. Now, US rate setters may not signal a dovish pivot just yet, said Marinov at Credit Agricole. You may have seen him in some of the docs. The USD could receive a boost if the outcome of the July meeting and data releases keeps markets guessing about the timing. So if we have a little look at the timing whilst we are here, this one, and see if that is still suggesting September. So obviously July, that's fine. We're more interested in September. And that still expects rate cuts. Essentially, what people will do is watch the data, watch what the Fed says up until the September meeting, and then they'll just continue to price that in up until that until 17th of September. So what we need to do is essentially, this week is a good example where we have a lot of key data releases. We have the Fed as well. If the Fed is really hawkish or pretty hawkish, and the data is still pretty good, we don't need it to be extremely strong. We just need it to be holding pretty well and not crumbling. If it's holding pretty well and the Fed's relatively hawkish, then you would expect this bar to push lower because markets price out the rate cut. They then price in a rate hold, and that will support the dollar probably throughout the summer, to be honest with you. Obviously, you will have pullbacks, but that should be the case at least in my opinion. Now, that could actually allow your dollar to trade through 115, possibly a little bit lower. Red Fed easing call. We've just read through that. Now, if I just quickly get up this as well, and we'll have a little look. The date is there. So let me open up this. And this is from JP Morgan. They do talk about a bit on the dollar, actually. They say, where am I? Standoff back to dollar had a chance to rally, but was short-lived, yet the same could be said for the sell-offs too. The credibility issue for the greenback is familiar. and well entrenched, and we have come a long way to guess. The question is, what next? If the Fed is not cutting this week and the US data, just zoom in, doesn't come off the rails, can see why we might just take another breather here. Gun to my head, still think dollar ends lower overall, but market feels very summary right now. Obviously, if payrolls is weak, then things can reinvigorate, but cross that bridge when we come to it. Obviously, they're saying they just reduced some of their trades in the run up to the meeting and had some short dated USD CAD downside. So all in all, coming in fairly light risk, especially in cash, and look to be a bit opportunistic. Sorry about that. Until some sort of more consistent signal reasserts. If the dollar is to rally from here, then perhaps cable, AED, and yen look the prime candidates. That is true. I would agree with that. AED especially, because the AED has rallied quite nicely against the dollar. So markets could use that as the opportunity to remove the extended positioning in the AED and put a bit of market movers into AED USD shorts, for example. So that could be a good one. All you have to do is essentially just look at who's been bought the most against the dollar and just go opposite of that, because the dollar theme will dominate that stuff as well. We don't need to read through too much of this right now. I believe I did put some stuff in this from into the Discord yesterday. But you can pause this and just read through that. And of course, this bit here as well. We'll speak about a bit on the yen as well for now. But yeah, I mean, I'll share my screen for technicals because overall, obviously, there's been a trade deal between Europe and the US. Cool. It will, of course, benefit the US, at least for the time being, because now markets will see that actually, the trade relationship with other people could also improve, and that could support the USD as well. People will not be seen as too bad of an issue as it was around April time. Couple that with the data and the possibility of a hawkish Fed, because the data has been relatively okay recently. People were expecting it to really drop off a cliff, but we didn't see that. So there people were like, oh, that's a bit of an interesting one. Maybe we're going to see a bit of a hawkish Fed that would allow the dollar to remain stronger. So with that in mind, dollar CAD, we could push towards 139.250 to 140, basically into these highs throughout the summer. We could possibly aim for this high here. That's absolutely fine with you as well. That, there is no right or wrong answer at the end of the day. But it just depends on your risk appetite. But yeah, either that high there, because that's the next high after these highs here. And then after that, the next high is obviously around 140 if you just round it to the next whole number. So this one will be 138,500. We're just working in clean cut numbers. And then this one will be 140, just as a nice big round whole number. 140. There we go. So those would be your targets for dollar CAD. I would look for buys, to be honest with you, at this point, given what we know. I would just wait for some pullbacks. We were looking for some buys last week, as you can see, but we just didn't get into those demand zones. It looks like it's going to be choppy price action on the way up. Dollar Swiss as well. You could also get into that, given how sell-off this has been. So let's delete the technicals now, refresh and start from the beginning. So because we have an idea that the dollar could be stronger, if we go onto COT data, have a little look. So yeah, a lot of they have, selling pressure has been really bearish for quite some time. So this would be a very big pair for you to get in on some bullish dollar. So what do we do? I mean, you can kind of see people's already starting to do that. And it's still early days though, don't forget. So what we now need to do is look for longs. Basically here could be the first target. And then the one after that could be about 83. And then about 84 would be that one after that sort of break above these highs here. So ultimately, the best one would be 84. But let me just delete that. 84. But for now, we'll aim for that first high and then just see from there. So what do we do? Well, we try and find area of demand because we're looking for some tactical buyers. This is a perfect example of a tactical position. So the only region I would be watching would be about this 3-hour demand zone. There is a lot of imbalance there. I know people like to trade that. It's also known as fair value gaps. They're exactly the same. It's just been reworded. So there's also a little daily demand zone down there if we do get that pullback. But it seems as if markets are really jumping on board. It will be, for me, just shallow pullbacks for now. So that's why, hence, like if we just fib this up, that is a shallow pullback, isn't it? Like it's above 50%. That's quite shallow for me. So yeah, dollar Swiss, you can capture a decent amount of trades. Dollar yen as well. Obviously, the Japan and the US trade deal, that's fine. But yeah, this is going to benefit the US at least over the near term. I don't know how yields are performing. A little bit lower across the board. But yeah, dollar yen, in my opinion, could be another good one. We spoke about 150 last week. That would generally just be the target for dollar yen on the upside. Hopefully then around, what was it? January, February, March, April, May, June, September, maybe towards September going into Q4. September is obviously Q3, end of Q3, beginning of Q4 would then maybe we can get back into dollar shorts. We'll just have to see what fundamentals are at that point. But yeah, for now, dollar could remain a bit on the stronger side. Dollar MXN, I guess you can also get into if you wish to do that. It has been sold off quite aggressively, as you can see. So there is a decent amount of upside. If we go, I know some people could do this as targets where just go from the low to the high, and then 50% could be a target as a pullback. It's quite a lot of pips there. Obviously, USD MXN is a bit more volatile. But yeah, for now, that is myself on the dollar. Those are some trades. In regards to the pound. In regards to the pound, let's quickly have a little look. Let's start off with this one over here, which they say there's outsized moves in the US in Euro GBP. And we saw a huge move lower in Euro GBP yesterday. Ex post, it could be seen as the UK having a better deal than the EU when it comes to trade. In reality, however, it was probably all due to positioning, where opposing fiscal and monetary prospects between the Eurozone and the UK had made long Euro GBP one of the conviction trades this summer. That clear out may have run its course, and the fact that GU has now broken under the support suggests sterling sell-off can continue alongside the euro. There's a technical case now for Euro GU to trade down to 131.550. That is our preference in the week, where we think the events are risk skewed for positive for the dollar. I would agree with that. The US data has been pretty well. It's difficult just to see like periods of a good way of explaining it, a good way of referencing it would be something like this for data, where if the data, most of the data is kind of like holding relatively steady, right? Like you are going to have little bouts of weakness in certain bits, but the majority of it is kind of strong or holding well. You're not just now going to start to see like big drops in the major data, because what you need to see is what's the word for it? I can't remember now. There's a word, forward-looking indicators. So you need to see like the big drops in the PMI data. You need to see other avenues of data like the durable goods, those all to start falling to give us a guidance that now other bits of data will start to fall. If we're not seeing that, which we're not really seeing, it's a bit difficult to say the dollar US data is going to now fall off a cliff, or at least really sell off. People are expecting it because rates are pretty high for a while now. But until we see that, you can't just be like, oh, the US data now needs to start falling, Obviously, if you have a big risk event, then that's another avenue of data coming in really weak, but we haven't really had that. Still, it seems as if deals are now starting to be made. That's generally going to be pretty good for the US and its data. So I would agree with that to some degree, that we could actually come lower. I did put a trade in at this daily demand zone, or I'm looking for a trade, but I actually kind of doubt that we'll reject from there at this point. They were saying about 131.50, wasn't it? Yeah, 131.50, which would be about just into this low. So yeah, that would be the first target. Then the next target below that, if the dollar can still continue to remain strong, would be, as you can see, 130, because it's a nice big round whole number. Now, with that in mind, let's have a little look at this one over here. And I just want to see what their views are on the pound. So where am I? The issue with this at the moment, right, is there's not that much UK data, to be honest with you. So I'm just going to try and just bring this up and see if we have anything. Let me just quickly share my screen. Now, but you can read through this. They talk about the tariffs in a bit more detail. I will include that in the, in the euro, because it's obviously a bit more prevalent for them. But euro being made fresh 2-year highs with the announcement of the US trade deal, but resulting price action has been a little disappointment. I'm still bearish on the pound, but worried that we will not have much impetus to take the trade further over the next few weeks before the August NPR. So a good way of looking at that is you can see how people need a reason to trade it further. Like they're saying there's not an impetus, so there's not like a reason for it to continue to trade above where we're at. if with that in mind, that could be a reason for you to take out some of your trades. And I've seen a lot of people do that, where if there's not a reason for you to hold it, you either exit it or go the opposite direction. Now, it's importantly technical, and dips should be brought back towards the level. I'd stick to abandon the bias for the near term, but we're still good for a few weeks away for the autumn tax hike circus coming to town. Flow-wise, DHFs sold a decent amount of GBP for the second day running, while SHFs remain buyers, better buyers with increased vigor. For cable, 133.650 is the support to watch, with 135 to 135.3 above. So obviously that's the resistance. What's DHFs? I can never remember. And SHFs. I'd have to Google that. But yeah, what they're saying is there's not that much trades to come through from a UK perspective, or data, sorry. So it's a bit of a tricky one to sort of trade at the moment. I would actually more focus on GU. Yeah, mainly GU, actually. The other trades out there will be a bit more on the tricky side, because a stronger dollar will also be a relative downer on the AUD and the NZD. But the issue for the pound is it's also pretty weak. So you're also going to be trading week versus week. And that's, as you know, not an environment where you should be trading. You want to be going where there's divergence, because that has higher probability. You're going for higher probability setups, aren't you? So because that doesn't really infer to me, or at least gives me a suggestion that there is going to be a high probability setup there, I will leave those trades alone and go elsewhere. So in terms of technicals, because again, not much else to talk about on the pound, to be honest with you. GA, we may see a little bit of a pullback on GA now, just given that we may see a little bit of AD weakness. How we reacted from? We may have just come back into this daily demand zone here. Oh, we just missed it. Okay, never mind then. I was just thinking maybe we just came back into there. It doesn't seem like there's any region that we came into. But yeah, to be honest with you, I would doubt GA goes lower, at least over the near term. Mostly on the factor that AUD could also remain a little bit on the weaker side as well, because as the dollar strengthens, that could allow possibly the S&P to come lower, although I would doubt it, because this is generally also pretty good for US companies also. So, okay, that's something to consider. However, if we look at price action recent, like on the basis of yesterday and today, it does seem as if markets are kind of getting on board the possible AUD strength. Obviously, euro is a bit different, because euro is also pretty weak at the moment, and it's not something I want to be fighting. So like a euro AU could also come a little bit lower towards like these lows here on the basis of euro weakness, which is then a factor of the tariffs picture. But I'll speak about that soon. So GCAD, I will leave alone. There's not that good of a direction for me. G Swissy, not really looking at. GJ, I am not looking at. GN either, and GU is a good trade. Obviously, we'll monitor this daily demand zone because it's still valid. However, based on what we know, if this week's data has been pretty good for the US, then I doubt that will go above, or we may see a little bit of reaction, but then we may just come back low again. You may have seen trades like that where you enter into your trade, you go into a bit of profit, and then it goes straight back to either your stop loss or your obviously break even, depending on your risk strategy. So with that in mind, the next low for me, the most probable one would be about, like what ING said, 131,500. Basically this low. If we trade below that, then 130 is the next one after. So that is myself and the pound. I've not really got too much else to add on to that. Again, there's not much else in terms of data. The pound is a little bit on the weaker side. I would rather trade that against the dollar for the time being, just purely because the dollar has a lot of like strength potentially coming through. We could capture that quite nicely. So if we can get a little pullbacks on GU on the shorter term, I will definitely be looking to get in. So that's myself on the pound. Let's move straight on to the euro. So the euro, in regards to the euro, let's quickly have a little look. As you know, there were some sort of deals being created, which generally should sound pretty good for the euro on paper, which it is, because it just means they're not going tit for tat with the US, where, you know, Europe will retaliate, so will the US, Europe will retaliate, and so will the US, and it just isn't more of an issue for Europe, to be honest. So now that there's been some sort of deal, at least it's concrete, and it sort of gives that people some sort of stability. and company stability at least. So that's the good signs from it. Let's look at the sort of why is the euro weak on that basis. So let's start off with that Bloomberg article that we opened up earlier, and we'll have a little look at as to what they are saying. So euro drops the most since May as reality of tariffs sink in. The euro dropped most in over 2 months against the dollar as short-lived optimism over the trade deal between European Union and US gave way to concerns over economic fallout from still lofty tariff rates. The single currency fell more than 1%, the biggest drop since May 12th, making it the worst performer in the basket of major currencies. The prospect of a deal between the US and Europe following 3 months of negotiations sent the euro surging last week to near 3-year high. But the focus is now turning to the potential headwinds to the bloc's economy, with tariffs heading to their steepest in EU's history. And Europe avoided disaster, but locked itself into an imbalanced, high-stakes pact with no clear exit ramp. The US extracted every ounce of leverage. So they just squeezed as much as they can out of Europe. Now, the tariff uplift will erode 1% point from the region's growth, which is likely to grind to a near halt in the coming quarters, says Pacific Management Co. Still, the impact of the policy uncertainty on corporate behavior is still difficult to estimate. So we'll just have to see how it plays in the sort of the months ahead. And the trade deal with the US isn't a win for the EU. That result will be played out in the markets via the euro. It has some way to run. A trade deal of any sort removes the worst case scenario for the global stocks, but a win for the US and a loss for the euro is sure to be a catalyst to sell euro dollar, which is true. And that's kind of what we've been seeing at the moment. It's a bit more beneficial for the US than it is for Europe. So that's somewhat of a good way of looking at a tactical euro dollar sells. Now, today's euro move makes sense, says Pickering in an interview. There's going to be less demand for the euros to buy exports from the Eurozone. And Chris Turner at ING still sees the euro making gains to 120 this year. But while the deal favors the US, the European companies will no longer be hobbled by such uncertainty. That's what I was just speaking about earlier, about how it's, at least it brings some sort of stability. That's the kind of good news about it. Still, Turner expects the euro's move next to be lower, particularly if the markets keep pushing back the Fed's rate cut expectations. And that's what we're speaking about, how this week the data is going to be very, very important to see how, does market pricing suggest a September cut is still likely or not. If it's in the not camp, i.e. the data's pretty good, the Fed is a bit more on the hawkish side, in that environment, you would expect September rate cut to get pushed out. And obviously then we're into summer months, which is August, which is generally a bit on the quieter side. So don't be alarmed if you see markets be pretty dead throughout the summer. And then obviously as people get back from holidays, etc., around September time, that's when markets start to get juiced back up again. Now, lastly, whilst we're here, let's start off with this one. And that was that JPM doc that we were speaking about earlier that talks a lot on the euro, which it is. I left the euro was 116 and here we are. I guess standing back, we have had resilience in the data and overall confident message from the ECB. And now trade deal agreed with the US, which at 15% is less bad than feared. But the question is, why aren't we higher? Well, I guess the dollar has sold off a long way in the first half of the year, and the data doesn't justify a Fed to cut this week. Themes are mature, and therefore conviction levels are naturally a tad lower. Basically, when they say themes are mature, basically the theme of like tariff, the theme of like euro dollar going towards 120 is getting mature, as it kind of suggests. So that's something to consider. Obviously, above 120 is going to be a bit of a push, I'll be honest. If we continue to go with the way we're going, if we improve for better of Europe, then obviously it will go above 120. But if not, we'll sort of stay around 120, a bit below 120 towards the end of the year. Now, well, I guess the dollar has sold off a long way in the first half, and we aren't short-term. The lack of extension over the weekend and see some excitement coming up the currency post-ECB bump. From here, there still seems like a bit of equilibrium, and we'll see how the US payroll shake out. Some justification remains for euro outperformance in my view, which is the moment expressed via medium-term toppage. Refreshing levels last week around 115.60, and obviously they're looking at the 50-day moving average there, which is also fine. It's their opinion, of course. Now, the news over the weekend was that Europe has struck a deal similar to that of Japan. Obviously, I don't know why they put this in the pound section, but here we are. And a vague large number flowing into the States. Clearly, this is good for Europe, as tail risks have now been avoided for now. But the question we have to answer is whether we are starting to get enough certainty now for the US. Feels like 15% baseline everywhere, and Trump's relaxing on Powell for confidence to return to the USD. It would make sense if that would happen. I still think we are quite a long way from that, and the tanker has already started turning on what has been a multi-year overpositioning on the greenback. Sorry, but it does make sense for consolidation to continue here, especially if the US hard data can continue to hang in. Trimmed USD cash here and back to running reduced dollar call for now. So people are just starting to take out of their shorts on the dollar over the near term because of this new profound strength in the US, i.e. the data's holding relatively okay. A lot more deals are being made. So that fear of that real big weakness in the US from a tariff perspective is no longer sort of there, or at least has been minimized by a fair amount. So people are like, well, in this environment, the dollar absolutely strengthens. And as a result, you are seeing that being bled through into like euro dollar sales. Euro CAD had also sell off. That can also continue, actually, if that's the case, based on the USD. So that's myself in the euro. In terms of technicals, we'll just have to see a bit more on the data front this week, of course, because, again, as you know, we have inflation, German inflation, I believe. And then, of course, we have a bit more news on Europe inflation as well on Friday. And then we'll have a really good gauge on what the Fed wants to do, what the US data is doing, etc. And obviously, if that's the case, euro, I'll leave it alone, but I can understand why people would want to get into sells, mostly on the basis of how strong the euro is. And this new deal looks good on paper because it's no longer as bad as people are expecting. But it does bring into question that maybe it's just going to slow the economy a bit on that side, on that sort of avenue. As a result, maybe the euro is a little bit overvalued over the near term, and therefore the euro can come in lower. I would agree with that sort of thesis there. Obviously, in that scenario, it can also weaken because dollar strength, I'll be honest. However, it just seems as if because Europe's news is more new, people are trading that in, if that makes sense. Like we've already known like the AED was already pretty good. It was doing pretty well. The China tariff, that was all old news for the last few weeks. But now that there's this new news, people are now going to want to price that in, and they'll look at like Euro AED, which has been quite overvalued for quite some time. So people may use that as a reason to take profits. And I would agree with that. If you want to trade that thesis, you're more than welcome to do that. How's the weekly COT data doing? Oh, I don't think it has it for this. Oh, it does. Perfect. Yeah, I mean, weekly COT data, which is generally what you should be looking at, is overvalued. And the reason you look at weekly is because COT data comes out weekly, not daily. So look on the weekly time frame, you can see it is pretty overvalued, has been there for literally since April. So people now may, because since April, there wasn't a reason to take out those longs, was there? It was all really positive for Europe. But now that we're starting to see a little bit more negative news come through, this could be that reason to get in. EuroCAD is similar. I would actually look at it more through the angle of dollar strength. And as you know, in that environment, the CAD strengthens on the crosses. Therefore, EuroCAD comes lower. And if we were to want to try and get in, let me just delete all this because this is old technicals. What I would want to, I mean, in an ideal scenario, this would be the perfect way to get in this daily supply zone. We wait for some sort of breaker structure and then we get in. We're not really seeing that. So I think you may have to be a little bit more aggressive, I'll be honest. Like, for example, how we just came into these last lows and then rejected. So if we come into that sort of these last lows again on the pullback, you can try and get in. That's a bit more on the aggressive approach. And then a target, you could just target the first low, which would be here. And then that could be your trade. Euro GBP, that's a tricky one, actually. Yeah, it is a tricky one. I mean, logically for me, it would make sense for a little bit more weakness because of overvalued euro in the near term. But pound is also not pretty strong. So I don't think the downside is going to be by much, I'll be honest. If the pound was strong, then you could infer from that downside could be like there or even all the way down there. This is the daily time frame, don't forget. And then you trade your technicals accordingly. But because the pound is also pretty weak, I doubt we're going to have a lot of downside until we see some sort of new update, I'll be honest with you. So from now, I'll leave that alone. Euro yen, I guess you can understand why you'd want to get in, given how stretched this is to the upside. If you want to just trade it to the 50% of the leg, you're more than welcome to do that. That's completely up to you, though. It's a bit on the risky side, though. Euro New Zealand, we haven't traded above here, so technicals have started to reject. So I'd rather get into some sales at this point now. If we just base it on technicals, and it also kind of does make sense as well on the euro front with what we've just found out about the tariff scenario. So in that perspective, let's see. Okay, so the only region I would be watching would be that 6-hour supply zone up there, which is right here. Obviously, that's a really ideal world, but as we know, markets don't move like that. So what I would also be watching is sort of these lows around that sort of 94 300 level. Sort of these lows here that were created. I would be watching that. And then lastly, euro dollar. We're very close to 115 now. Obviously, we were watching 116 as a push. We did see that, but then we saw a lot of negatives now start to build for Europe, positives starting to build for the US. And in that scenario, it can go lower. So what do I think now? Well, in my opinion, I would probably expect it to break below 115. So let me delete all this and delete that. So if we break below 115, we could come towards 114. And then below 114 is 112. So basically, I'm just looking at the lows, and you can see the low here at 115 is there. The low here is there. Well, the next lows are sort of around these wicks. So I just rounded it to 112. And then below that would be 111. Below that, obviously 110. Below that, 108. So you're just looking at lows. So for now, I do think we can actually break below 115 and go towards 114 based on what we know. That obviously, what that is all built on is in the assumption of this week's data in the US is holding good and the Fed is still pretty hawkish. If the day's bad, if the data is really poor, then markets will consolidate euro dollar because there's not a reason to trade euro dollar all the way back up to 120 or above this higher. And there's not a reason for it to trade all the way down below because you've got dollar weakness as well. So in that scenario, you'd see consolidation. But if we see the scenario where the data is actually pretty well, we don't need to be really strong. We just need it to do pretty good or hold well. And the Fed is hawkish, then 114 would be good. 112 would be the absolute maximum, possibly 110. But 112 for me would be a bit of a stretch on the downside, I'll be honest. So that is myself on the euro. Hopefully that's been a bit on the constructive side. AUD, let's see. With the AUD, right, what we have to think about is what is driving the strength of the AUD at the moment. Now, Deutsche has made a video on AUD and a very, very quick summary on it, and I'll just quickly show you. What you have to think about is what is driving AUD is mostly on the avenue of tariffs. So tariff meaning the deal between China and the US. That is very good for Australia. So considering that that's still the case, you would absolutely still want to remain a little bit long the euro, especially because the S&P is also pretty strong. Because S&P is also pretty strong because, remember, S&P can either be driven by Fed expectations. So if the Fed wants to hold or be hawkish, technically that would be bad for the AU, for the S&P. But because the tariff deals are being created, that can give the people the viewpoint that, the viewpoint that the worst is behind us for the US. So people want to be a bit on the optimistic side. I can understand that. So what I want us to think about today, or this week, sorry, so tomorrow actually for the Fed, is Fed comes out, they do whatever they're doing. So are they hawkish, are they dovish? How does the S&P react to that? If they're hawkish, does the S&P sell off? If it doesn't and it doesn't react, then it gives you the idea that the S&P or just equities in general is a bit more, what's the word I'm looking for? They're a little bit more concerned about the optimism in sort of the US if you're looking at the S&P. If the optimism in the US is good because tariffs aren't really such a massive weighing factor anymore, then the S&P should continue to rally. As a result of that, the AUD should also do a bit of strength as well. So that's the things I largely want us to think about for this week is how does the S&P react to the Fed? Now, the AUD has obviously risen, the second best performer since we turned long in May. Number one, fundamental support was finally turning. The worst had passed for China and broader risk sentiment. The domestic Australian economy looks sound with fresh green shoots. And number two, the AUD would have room to catch up with fundamentals as the drag from key flows, i.e. super funds buying an offshore account, could moderate. And that seems to be playing out, helping a moderate catch up lately. Super funds bought foreign equities quite aggressively from mid-24 onwards, but the April and May's US tick data suggests that appetite may be waning. And that's consistent with the sentiments expressed in recent media. Elsewhere, global reserve managers cut heavily on AUD exposure around the turn of the year, unwinding a good chunk of the build-up in pre-sending years. That's hard to understand, but potentially related to received risk sensitivity as the world approached a more turbulent period. Trump, what he was saying about tariffs, etc. That would make sense. And AUD exposure had looked more attractive in the world looking for dollar alternatives, given a strong credit rating, reasonable yields, and good liquidity, at least on the private institutional side. There have been media reports suggesting offshore inflows for blue chip equities and real estate. So this is all generally pretty good for the AUD. And as a result, that's what I was saying is, like, the AUD is now starting to become a bit more, like, the last couple of years has been pretty bad for them because there was a lot of negatives, but those negatives are kind of mostly gone now. And what we're kind of seeing is a bit more positive in that sense of data or just sentiment in general. And then from there, you think, okay, cool, the AUD should strengthen. Who is it going to strengthen by? Well, by that, you think who's weak or who is expected to weaken. That's why I was saying, like, Euro AUD could come a little bit lower, at least over the near term. If you see what I mean? Like, you're just choosing selectively what trade you want to be taking. So that AUD is still a very, very good trade, even in an environment where dollar strengthens. Obviously, it can weaken off, but once that starts to become a little bit stretched, that's when people will start to get in. But what I want us to see in particular is how does it react to the Fed? How does the AUD react to the Fed? Because that gives us good guidance on what is it following more, the dollar strength or the S&P strength. That will give you a good idea. So Fed really hawkish, dollar strengthens. Does the AUD come weaker? If it doesn't and it goes higher and the S&P goes higher, then you kind of give it, like, you can infer from that the S&P is the driver of the AUD, and that's kind of what you follow. So that's myself on the AUD. Very quick, very simple. I mean, we've not really had much updates. Obviously, we do have some inflation tomorrow morning. Let me just double check the calendar. I'm pretty sure it was the tomorrow morning. Yeah, 2:30 tomorrow a.m. Let's see how that plays. Obviously, we know the RBA was hawkish. So if they are suggesting that inflation's the reason that they held, and inflation comes in sticky tomorrow morning, then you would be like, okay, cool, that's very bullish for the Euro AUD. Who am I now going to buy the AUD against? Well, you're going to buy against the Euro for sure, possibly the Pound. AUD CAD, maybe. AUD JPY, yeah, I guess so. AN, yeah, it's a bit of a slow-moving pair, I'll be honest. Not AUD USD. Euro AUD would be the best trade there. Then AUD CAD, I'm not looking at. AUD JPY, I'm not looking at. AN, no. The only one reason I would be watching, or the only trade I am watching that's AUD really, is Euro AUD. GA could be another one, but I'm just a little bit interested to see how that plays over the week. But Euro AUD just seems the better divergent because Euro is brand new weakness. So that's what we want to capture. We want to capture the brand new weakness. This is how you get in at the top of the trends, where you see something happening and it's starting to occur. You don't wait. You get in, see how it plays. If you take the loss, that's fine. You move on to the next trade. But this is something where we could capture some AUD strength. Now, apart from that, that's myself and the AUD. I've also gone to the NZD, which is largely following the AUD. It's actually really simple for them at the moment. NZD has been relatively decent at the moment. They've been a bit more on the hawkish side. And as a result, the data has been relatively okay. The RBNZ has basically pretty much stopped cutting now. And considering the sentiment is slowly improving, that could support the NZD. So as a result, you could trade Euro New Zealand to the downside over the near term. You could trade, for example, GN if you really want to. But like we spoke here, it would literally just come back to these lows. But yeah, you can see Euro is the main focal point for me on this breakdown. So yeah, that's my New Zealand one. Data-wise, I don't think we have any Let me just double check. New Zealand. Yeah, literally nothing. Next week, we have a bit of employment data on Tuesday. So that's at least something to look forward to. So yeah, that's myself on the New Zealand dollar also. Pretty quick today. Canadian dollar. Now, this week we do have the BOC. I just want to double check if ING has done that Bank of Canada outlook thing that they normally do. I just want to double check. It may have done it. It may not have done it. But let me have a look. I'm not seeing much. Yeah, I'm not seeing too much here. Let me just double check here. I think we have seen some. Now, Morgan Stanley has upgraded their neutral at Morgan Stanley, or to Morgan Stanley, for the Canadian dollar, sorry. Having held a bearish skew on the Canadian dollar, Morgan Stanley strategists think stars are aligned for a more robust spell. Given the shift in tactical stance, the investment bank strategist desk says it exits a short trade that looked to benefit from ongoing CAD weakness. 2 of the 3 original reasons for betting against the Canadian unit were elevated trade uncertainty expectations for the Bank of Canada interest rate cutting cycle, terminating at 1.75%. However, both assessments have since changed. While trade uncertainty remains high from a historical perspective, it has eased somewhat since April due to the trade deals and the USMCA exemptions. Economists have revised their Bank of Canada terminal rate to 2.25%. Analysts that USD CAD has room to decline from a compression in rate differentials. So basically, US yields could be at like 5%, for example. Canadian yields could be at 3%. And that convergence where, or let's say 3% as just this example, a compression of the yields would either be the US yields coming lower, closing the gap, getting closer to 3%, or the Canadian yields rising towards 5%. Well, why would it rise? Well, considering Morgan Stanley has upgraded their terminal rate, meaning this one here, which basically suggests that is the last, that's the level at which the Bank of Canada will no longer cut rates. Previously, they were saying 1.75. Well, they upgraded that by 50 basis points. So at least yields should pop in Canada or at least remain higher in Canada, compressing that yield advantage with the US, as it was previously expected. Now, the Canadian dollar has meanwhile risen against most of its peers this week. As follows, the US dollar higher, confirming its proxy for the dollar to strengthen. So that's what we was looking about. EuroCAD seems to be that good relationship. And the traded deal between the US and the EU lowers global trade uncertainty, allowing the dollar to move higher. It also suggests that there is enough momentum in the US side to allow it to push for a new accord with Canada. So let's see, actually. Canadian dollar, Bank of Canada wise, we're just honestly going to have to see what they do. I don't think they're going to do much, I'll be honest, just because not much has really happened. But what I want us to focus on is what do they say about the future of policy? So Morgan Stanley upgrading their forecast is generally pretty good for Canada. That would make sense. But does the Bank of Canada express that view tomorrow? Are they hawkish or are they dovish? That's what I'm more concerned about. If they're more dovish, then we could see a little bit of Canadian dollar weakness. It could be those pullbacks. But then I think if we see the pullback in like EuroCAD moving upwards, I still would think that would be a good opportunity to get into a short, I'll be honest with you. Just because, again, what we have to think about is what's new. And what is new here is Euro weakness, not Canadian, be it Bank of Canada being dovish. So therefore, you could infer that Bank of Canada being dovish is volatility and not trend making. Now, that is myself on the Canadian dollar. The yen and the Swiss. Let's have a little look. And this Bank of Japan must increase rates, says Suntory's CEO. Japan's central bank should raise rates when its policy board meets this week. The failure to do so will weaken the yen and exacerbate the inflation. Because as you know, if yen weakens, inflation does rise in Japan. There's a good, real, close relationship between dollar yen going higher and inflation going higher. It will be the governor's responsibility if the Bank of Japan falls behind in responding to changing economic conditions. Where he was speaking at the head of influential business lobby. Earlier on Bloomberg, he called for policymakers to increase benchmark interest rates. It's unusual for Japanese executive to directly call out Ueda, the central bank governor who has begun tightening rates after 17 years of loose policy, while Nanimi is known as an outspoken corporate figure, putting pressure on officials ahead of their meeting. So this guy, It's causing some havoc. Meet on the Thursday, and Friday is an aggressive move given that they expect rates to keep steady. So obviously we know the BOJ is also meeting. So what I do want us to also focus on is what do they say about future policy? Because markets are still on the fence whether or not they're going to hike again this year. If their language infers that they are not going to hike again this year, or at least like markets interpret it that way, then the yen will weaken off a lot more. As a result of that, you could get into some tactical yen weakness, especially against the dollar. So dollar yen could move very aggressively towards that 150 level. Now, in that regard, let's quickly have a little look at Goldman, sorry. And this is what they say. Now, bullish, but wary of tactical risks. There are a number of potential catalysts in the week ahead for the yen. The FOMC decision, the BOJ decision, payrolls, and August the first trade deadline. While we see the risks are skewed towards renewed dollar yen downside, we see 3 reasons to wait for more event risk to pass before adding fresh yen shorts. First, the yen has seen the largest vol adjustment moves around the BOJ meeting over the past year. And while that would argue for a bigger reaction to any hawkish message from lower uncertainty on trade, including a likely upgrade to the growth with possibility less caution around future hikes, there's also no urgency to raise rates, and markets have already moved pricing to roughly 65% odds in October. So that's the only meeting that they mostly see a rate hike. After that, it becomes a bit more clouded. So what markets want to see is there a clear update from the BOJ this week as to what do they actually want to do? Are they still on the fence? Are they still waiting? If they're still on the waiting fence, this will weaken the yen because markets like certainty. Second, we think our baseline for a relatively benign macro backdrop has scope to leave dollar yen downside a slower grind, especially if the oncoming data continue to argue for Fed cuts to be pushed out. So that's another risk for you to consider. Obviously, there's other ones out there like the LDP leadership. Obviously, that's expected to change. That could create some volatility, uncertainty. So what I want you to think about is, based on everything you've heard, is this a bullish factor for the yen? I would argue not. In that scenario, or the factors that could happen this week, is this a scenario where you want to jump into a trade? Probably not, let's be honest. As a result, like what Goldman's saying, it's probably best to wait and see what happens and then make the assumption from that. If what happens this week is really good for the yen, then you're going to capture some nice trades. But if not, and the risks are skewed for the yen to go lower or at least the dollar to go higher, then in that scenario, I would rather not try and buy at the highs, which is pretty much what you're going to be doing at the moment. We've seen pretty much no pullback. As a result, you're buying at the highs, which, as you all know, is very newbie. You kind of want to wait for the pullbacks and then get in. So that's myself on the yen. Swiss-wise, I really have not got much. Just want to see what they say. Despite the trade, overall, I still expect the franc to trade better bid ahead of the August 1st, but conviction is low, so not running any positions at the moment. Yeah, I'd agree with that. You can see how very shallow and very quick that is. There's literally no trades with the Swiss. The only ones that I would see actually would be dollar Swiss upside. And we spoke about that earlier anyway. So that's myself on the yen and the Swiss. In regards to gold, let's quickly have a little look. I did actually see yesterday that some bank or fund, whatever, was talking about $4,000 an ounce on gold. Yeah, this one. Fidelity, that's the one. Fidelity says $4,000 on gold is possible as the Fed cuts, dollar drops. I'd agree. I mean, yes, that is absolutely plausible. We spoke about that on Friday's breakdown, where we have, as we get towards the end of the year, Fed should still continue, hopefully should still continue to cut. In that environment, dollar comes lower, gold does go higher. Perfect. That would be upside for gold. 4,000 though, that is quite crazy. But it is absolutely possible. I'm not going to argue against that because the weakness could happen also into next year and markets will still want some sort of safe haven. So where are they going to go? Well, gold is obviously the next best thing, isn't it? And the rationale for that is that we saw a clearer path to more dovish Fed, adding some funds have doubled their 5% allocation over the past year, Also, August is slightly weaker for markets, so more diversification, which makes sense. Gold is up for more than a quarter this year, and uncertainty around Trump's aggressive tariff trades, conflicts in the Middle East and Ukraine, and central bank accumulated stressed gains. Still, the metal has traded within a tight range over the past few months, with demand for havens cooling a little as some progress in US trade talks have feared. So I would agree with that. What we have to then think about is the near term. What do I mean by that? Well, when I say near term or fundamentals, right? Fundamentals get split into two, meaning big long-term fundamental trades like gold going higher, dollar going lower because of X, Y, and Z. But is that tradable? Basically, does it make sense to enter those trades right now? I would argue not, because there's upsides for the dollar this week. Therefore, dollar can go a little bit more. Then at that point, your sales would get taken out very, very quickly. If I'm wrong and then the dollar goes lower, that's fine. I'll get in on the pullback. That's no stress. But what I want is confirmation and clarity before entering a big long-term higher time frame trade, if that makes sense. Because you can always add on to it. Like you get in, perfect, it moves. Like you're like, oh, damn, I only risked like 0.5%. Okay, conviction is still pretty high. On the pullback, I'm going to add like 0.75% or 1%. So in that scenario, I would be like, okay, cool. Yeah, I would absolutely wait for confirmation before looking to get in. So apart from that, that is myself gold. Yeah, to summarize, I would say for this breakdown is I would be more on the caution of dollar strength this week. You can use that as you wish. Like you could be like, okay, cool. That would mean like euro dollar goes lower or GU goes lower or AU maybe a little bit lower in the near term. However, you've got to remember is this is not really the market consensus for a long-term trend. It's a consensus or it's building consensus for a shorter term trend. So we could see like maybe the next few weeks of dollar strength. And then after that, the consensus is, okay, let's get back into dollar shorts when the time is right. So right now, the time is not right. I doubt we'll go lower in the dollar for the time being. So that's myself being on this breakdown. I went into a bit more explanations for this one. Please let me know what you think. But yeah, apart from that, myself and Drew will, of course, see you on Friday. Take care, everybody.